Everyone, just taking a look at the CPI release for the Canadian dollar that came out on the 20th, just a few days ago. And this is another good example of a continuation trade. So we had an inflation report, which we know tends to move the markets. And then when the release came out, it was above on both counts for the median and the trim. It was above the high deviation, and the revision was barely a revision. So this was above the high, it was a max deviation, and we knew that this sort of release would move the market. So if you look over at the charts here, here's the chart of the dollar CAD, and you can see this pair falling from the 139.60 down to the 139.40. And then there was opportunities for follow through here and follow through here on retracement, and then the market kind of just continued to trickle down after this into the following sessions. Now, one of the things that's really interesting here that is kind of an additional bonus thing to consider when trading risk events is the positioning of the Canadian dollar. So if we go over to our sentiment analysis tab here, you can see when we go down and click on the Canadian dollar, you'll see the hedge fund positioning right here on the Canadian dollar. And you can see that they're 84% short, and that open interest is up at the highs. So there's a lot of interest from participants, and the market is very short the CAD, right? Well, what happens when a news release then comes out like inflation that's hotter than anticipated, which might mean that the Bank of Canada doesn't have to cut rates as quickly? Well, what happens is some of those funds unwind their positions, right? So they were expecting dollar CAD to rise. Some of the funds unload their positions, and the dollar CAD, or the CAD rather, starts to strengthen and move down. You can see that sort of unwinding happen, taking a little bit of time. So that's an example of a risk event trade on the dollar CAD and the Canadian CPI. Hope that was helpful.